What's up guys, Ben here and welcome to Motivation to Invest. Cathie Wood is the CEO and Chief Investment Officer of ARK Invest, a company which specializes in innovative and disruptive technology, from 3D printing to genomics and even autonomous vehicles. She looks for companies which are set to disrupt an entire industry, and she's widely known as the biggest Tesla bull, predicting a $15,000 price target. So apart from Tesla, what other stocks has Cathie Wood been buying? Well, in this video, we're going to find out as I dive into ARK Invest's latest trades and reveal my top 3 disruptive technology stocks which ARK Invest is buying right now. So without further ado, let's dive in. Welcome back guys to Motivation to Invest. Before we get started, it would really mean a lot to me if you guys can give this video a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, let's get into the video. Right guys, so here we are inside ARK Invest's latest trades. Now it must be stated that ARK Invest's Innovation ETF is actively managed, which means it's actively traded almost daily. So we won't be looking at its top 10 holdings. I did that in a previous video, so I'll leave a link for that below. But in this video, we're going to just look at the top 3 most recent trades as of August the 28th. So there's 3 companies which I've highlighted and we're going to be diving into those. Kicking things off at stock number 3 is Lendingtree, the largest online lending marketplace in the US. Lendingtree is not a broker or bank, but it's a service which connects a network of these to its customers. For example, someone who wants to borrow some money will go onto Lendingtree. Then they will submit their information. Lendingtree will then submit this to multiple bankers and brokers within its vast network. Lendingtree's unique selling point is that competition allegedly drives down prices, so mortgage bankers and brokers offer lower rates and fees to get the customer. Once a Lendingtree customer has filled out their information, they will receive a call from a mortgage broker or bank within at least 10 minutes. The person on the other end of the phone is a trained salesperson whose job it is to find the requirements of the customer and secure the loan. However, this can be a double-edged sword. Once you fill out your application, you can be inundated with multiple calls and emails from salespeople from many different firms, which can be quite frustrating for many customers. The reason for this is that these are not just consultative calls. These are hungry salespeople who are dying to get that conversion. Picture the Wolf of Wall Street call scene.
My killers who will not take no for an answer. My fucking warriors who will not hang up the phone until their client either buys or fucking dies!
Right guys, so diving into the numbers, we're here on Stockopedia. This is my favorite platform for analyzing stocks. Like many of you guys always ask me, what platform do you use? So here it is, Stockopedia. Before we get into the numbers, let me just tell you guys, I've got a special deal exclusive for the viewers of Motivation to Invest. You get 25% off when you sign up to Stockopedia. So it's not for everyone. It is a great platform. I use it all the time personally, but it's not for everyone. So I'll leave the link below. You can check it out and see if it fits your investing style. Having said that, let's dive into the numbers for Lendingtree. So here we are on Stockopedia. Financials, adventurous, large cap, high flyer, quality 89, momentum 82, value 26, and stock rank overall of 76. So on Stockopedia, every stock is given a stock rank, which allows you to quickly look at the stock and say, okay, is it a good buy? Is it a good sell? Is it a good business? Stock rank 76, that's fairly good, so that's pretty high. Momentum, quality, both amazing. Value's not great, which would be expected for any of these growth stocks. Share price here, it's around $300 a share at the moment. Around March lows, it dropped to 137. So if you would have invested here, you would have doubled your money within just a few months. So that was a good deal there. Compound annual growth rate on the revenue for over 45%. So that is just incredible as it is. So generally, with regards to growth stocks, I consider a company a growth stock if its revenue is growing at least 20%. This is growing at over 45%, so it's a fantastic growth stock in that respect. Let's dive into the other details here. So revenue is predicted to decrease slightly for 2020, obviously due to the global issue. Increase again for 2021, and the same with the net income and earnings per share. So of course, this year with the health crisis, could be some issues with people getting loans, job security, etc. 2 hold, 6 buy, 4 a strong buy. But if you compare this company to, say, bank stocks at the moment, it's doing so much better, even though it refers banks and refers brokers, but it's doing a whole lot better in terms of a stock. So current ratio 0.66. That is pretty low. That's a bit too low for me, to be honest. Even though it is an online business, so I'd say it should have low overheads, 0.66 is very low. So generally, what I look for with a current ratio is at least 1.5 to 2. So the current ratio is your short-term debt to your short-term cash. So it's, does the business have enough cash on hand to pay off its short-term debts? That's those due within 1 year. So if a company's got a current ratio of, say, 2, it can pay off its short-term debts at least twice. And that's what I like to look for in a business. 0.66 is a little bit low. It's not really bad, but it could be higher. Price to book value 10, P ratio 87. So it's not a value stock. This is a pure play growth stock. On to number 2 is Pacific Biosciences, ticker symbol PACB. This is a biotechnology company involved with gene sequencing and next generation medicine. The idea with gene sequencing is to map your entire genome and thus predict which diseases are most likely to kill you. And then you can even edit those genes out of your system. This is great for hereditary conditions and even a variety of cancers. Let's say your family is prone to colon cancer, the same thing which killed the Black Panther superstar. Now, if you get your genes sequenced, you can find out which gene is triggering this colon cancer and thus have it edited out of your system. Now, this is an extremely simplified way of explaining how these biotechnology companies work, but in layman's terms, it just helps you to understand the process of the medicine and exactly the goal of the system. Now, I won't go into a massive amount of detail with regards to gene sequencing, and it's an entire industry on its own. However, what I will explain is that there are a variety of ways to map the genome, such as long read and short read. Generally, long read is more accurate, but this technology was held back in the past due to its high cost. However, these days, the price of genome sequencing has dropped to just a few $1,000s. Thus, this opens the door to the potential for this next generation medicine to become a reality. Some say this technology could expand life expectancy indefinitely. Do you want to live forever? In the future, the idea is that you'll go to your doctor and he'll have your genome sequenced next to him. Then when he's prescribing you medicine for a particular condition, he can align this with what's suitable for your genes. So here we are on the website of Pacific Biosciences. Pacific Biosciences, highly accurate long read sequencing, which provides the most comprehensive view of genomes. So this is their system here that allows you to map the different processes. So they do whole genome sequencing, variant detection, RNA sequencing, targeted sequencing. Let's play this video for you.
Introducing the PacBio Sequel II system, the most advanced sequencing instrument for generating highly accurate long reads. This platform makes long-read sequencing affordable for all scientists by generating more high-quality data in a single run.
Right, so there you go. I won't go into that too much detail. Pacific Biosciences, let's dive into these numbers. So according to Stockopedia, it's not looking great. Stock rank 39, very, very low. Momentum 67, value 6, quality 61. And I think the main reason for this is a lot of these biotech stocks, they're quite difficult to judge in terms of the traditional standard, in terms of revenue and cash flow and profits. You're looking at these because it's all based upon the technology they have and how successful it is and how widely it is adopted. So that's the main risk of these type of companies. I believe that's why the stock rank is very low. But in terms of the actual share price, it's been flying. So it's only a mid-cap company where it's around $3 a share just in July, and now it's around $7. So yeah, it's more than doubled over the past month. Compound annual growth rate only 8%. So obviously things are just kicking off for this company. It's still unprofitable, so that makes it a high risk investment. But it's in that zone. It's in the zone which can change the world, and that's the appeal of these stocks, especially to somebody like Cathie would. Revenue is forecast to increase massively for 2021, as is net income and earnings per share. Diving into the analyst consensus, so we've got people here from a variety of banks, JP Morgan, 2 hold and 2 say buy. Current ratio 1.15, so yeah, that could be a little bit higher. P ratio, not applicable. Price to book value 26, so it's overvalued, it's speculative, but the upside could be incredibly high for a company like this, and that's the risk you would take if you decided to invest in one of these biotech companies. And finally, number 1 on my list is 2U, ticker symbol TWOU. This is what's called an EdTech company, which combines education with technology to bring degrees online. They are a cloud-based software as a service platform which is empowering universities to run their entire courses online. Its partners include some of the top universities in the world, from Harvard to Berkeley and even Cambridge University. Right guys, so diving into the numbers for 2U. So as you can see here, adventurous mid-cap high flyer, stock rank 67, momentum 88, value 28 and a quality of 66. So pretty high stock rank. Share price was around $20, $15 in March. It's now over 40. So it's gone over 40. So it's doubled in the past couple of months. Compound annual growth rate, nearly 40%. So this is another extremely high growth stock. However, it's still unprofitable, as a lot of these innovative, disruptive technology growth stocks, they reinvest in the profits. They're trying to grow, gain massive market share, and then start turning profits. So you see this a lot with companies. So Uber is another example of a company which is still unprofitable, as was Tesla just a year ago. So things are obviously changing fast for these companies. They're trying to grow, they're trying to expand, but it's still obviously a risk if you're more of a value investor. You see these growth stocks and you think, bloody hell, it's not profitable. This is pretty scary. Don't be afraid. Just be aware of these type of stocks. Revenue forecast to increase. Net income's forecast to increase and earnings per share. Analyst consensus, 5 hold, 5 buy and 5 a strong buy. So we've got people here from various companies, Credit Suisse and various other capital firms. Current ratio 1.53, so that's a lot better than some of the previous companies that we've looked at. So they've got quite a bit of cash in hand. Price to book value of 4.24 and the valuation slightly better. So one of the unique things you guys will know if you watch this channel regularly is I'm quite transparent about the stocks I invest in. At the moment, I've not invested into any of these stocks. However, I'm very intrigued by 2U, and it is my favorite at the moment out of the 3 on this list. I just like the area it's in, online education. I feel everything's going online. We've seen universities moving online for a while now, and it just makes sense. They've already got great partnerships with a variety of the biggest universities and the best universities in the entire world. So to me, it seems like a no-brainer as a business. The valuation is a little bit high, but it's not as high as some of these other companies. So Yeah, that's the main benefit, I'd say, of 2U. Overall, Cathie Wood and ARK Invest are leading us into the future by empowering these innovative and disruptive companies. Many of these are true growth stocks, with the only downside being their high valuation. So the real question is, are you a growth or value investor? Growth stocks tend to have more risk, but can offer much greater rewards. So which is your favorite stock in the list I just mentioned? Let me know in the comments below and I'll join in the discussion. Also, I've got a special treat for you guys. So if you guys haven't already, be sure to download Trading 212 using my special referral link and you'll get a free share worth up to $200 or £200 when you sign up. If you already have this app, then why not consider downloading Stake app also? Stake is great for investing into a variety of US companies and has a little bit more of a selection than Trading 212. They also offer a free stock worth up to $200 or £200. So I'll leave links for both of those apps in the description below. You can download them, deposit, claim your free share, and have a Merry Christmas. Also, I always get asked which stock research platform do I use, and I've told a few of you guys before if you watch regularly, I use the stock research platform called Stockopedia, and I have a special discount link for that, which I mentioned briefly earlier. So if you guys sign up using the link below, you'll get 25% off when you sign up, and it's a great platform. I use it all the time, as you know, on this channel to research stocks and quickly look at a business and say, okay, is it a good buy or should I be selling right now? So I'll leave that link below. Check it out and see if it fits your investing style. In addition, if you guys enjoyed this video, I would really appreciate it if you give it a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.